In the previous lesson, it was described how debits and credits are used to show increases and decreases within certain T accounts on the balance sheet and income statement. The following is an exercise summarizing whether a debit or a credit increases or decreases a certain type of T account. The first question is, what increases an asset account, a debit or a credit? If we look at the debit and credit framework diagram introduced in the prior lesson, we see that all assets are increased by putting an entry on the left side. We know that debit means left, therefore, a debit increases an asset account. Contrarily, a credit decreases an asset account. The normal balance referred to in this exercise is describing which side represents the typical activity for that account. For example, it is not typical to have a negative balance in a cash account. Normally, an asset account has a positive balance. Therefore, an asset account's normal balance will be seen on the debit side. The next type of account in question are the liability accounts. If we look at the debit and credit framework diagram, we see that all liability accounts are increased by putting an entry on the right side. Credit means right. Therefore, a credit increases the liability account and a debit decreases the liability account. Finally, a liability account's normal balance will be seen on the credit side. Equity accounts are on the same side of the balance sheet as the liability accounts. Therefore, the equity accounts will be increased and decreased by debits and credits the same way as the liability accounts are. A credit increases an equity account and a debit decreases an equity account. Finally, an equity account's normal balance will be seen on the credit side. Next are the income statement accounts. If we look at the debit and credit framework diagram, we see that all income statement accounts follow the same pattern as the equity section of the balance sheet. Therefore, to increase a revenue, an entry is made on the right. Credit means right. Therefore, a credit increases a revenue account and a debit decreases a revenue account. A revenue account's normal balance will be seen on the credit side. Gains follow the exact same pattern as revenue accounts. Expense accounts follow a different syntax when describing increases and decreasing. An expense account represents a decrease in equity. According to the debit and credit framework, to show a decrease on the income statement, an entry is made on the left side. Even though an entry to the left side of the expense account ultimately decreases equity, it is considered an increase to an expense account. Therefore, to increase an expense account, an entry is made on the left side. Debit means left. Therefore, a debit increases an expense account, and a credit decreases an expense account. The normal balance is a debit. Losses follow the same pattern as expenses. This exercise, along with the debit and credit framework diagram, can serve as a cheat sheet until debits and credits are like second nature. All of the items seen in this lesson are available for download from the AccountingWITT website. Simply visit the Downloads page of the AccountingWITT.com website.